Hello and welcome to the Decrypting Crypto podcast. It is October 16th, 2025, and this is Off Chain, your weekly recap of the biggest stories in the crypto space. I'm Matt House Barbie, and as always, I'm here with Austin Knight. How you doing, Austin?
Woo, I am surviving, Matt. It's been quite the roller coaster ride lately, hasn't it?
It certainly is. Well, it's good to hear that you're surviving. From what I know about you from many years of knowing you, I know that you don't do a whole lot of leverage trading, which is probably
That's
a
right.
good thing in
I
the
like to sleep at
context of
night.
this. You do like to sleep at night, whereas I don't often like to sleep at night and enjoy periodically getting wrecked. Um, Thankfully, on Friday, I got a taste of getting wrecked, but thankfully, I keep my leveraged trading fun pot separate and small.
Hmm.
So, well, we're going to talk a lot about this today. I know for a lot of people in crypto, they've probably, been listening to a lot of coverage around what happened last Friday. Being kind of dubbed as like crypto's Black Friday,
Yeah.
and the huge drawdown that happened across prices, and in particular, how this kind of carnage was felt so much more in crypto versus in the equity and commodity markets. Even though equity markets definitely felt the kind of hit. Um, so I figured maybe we kind of kick off and we can just talk through a little bit around what's happened, because I don't know about you, Austin, but that's the first time I think I have just kind of sat borderline shocked watching a chart live in crypto since the Luna crash. It was because even FTX, I mean, I remember when FTX happened and that was like a little bit surreal, but it was happening over days, and then it happened and it was just kind of like, I don't know if this is actually real. Like, let's see how it plays out. When we had the Terra Luna crash, that was like a moment of holy shit, this is the wildest hour like ever, because we had USDT depeg and we were just watching like the cascade of everything falling and crumbling off of the back of it. Um, and this kind of felt similar to that, really. Um, I was literally, it'd been a very crazy week of work. And this was like Friday, late evening, my time. I'd finished up late and I was like, okay, I'm actually going to try and do something to take my mind completely out of crypto and work. I was like, my wife was like, okay, let's watch a film. I was like, yeah, let's do that. Put my
The
daughter to
Big
bed.
Short.
Oh, yeah, right. Put my daughter to bed, opened a beer, had a few sips, like, all right, yeah, let's get a film on. Let's do it. Let's chill. And my fucking phone is like gyrating, like almost like falling off the arm of the chair. And I literally have about, I'm like, no, I'm not looking at my phone. I'm just going to be, this is Zen time. I'm not looking, I don't care if Bitcoin's gone up or down. It's all good. Uh, and yeah, my phone literally vibrated off the arm of the chair. Like it
No
fell.
way.
Yeah. Like, and I was like, okay, I'm going to check something here. And yeah, I was like, oh, okay. This is a lot. This is like, I mean, just I think from Kraken, I had like maybe 10 price volatility alerts in like the space of like 2 minutes,
Yeah.
and then everything else. And so I was like, okay, just I just need to open my laptop to my wife. Like, she's like, what the fuck? I was like, I think something really big is happening. I just need to double check. I'm gonna go in the kitchen. I'll be right back. This is like, this insert SpongeBob a few moments later
Hmm.
kind of graphic. Yeah, I opened up charts and it was just like, holy shit. The just watching BTC price just first of all slam down to I think like 114 and then just immediately to 110. And I was like, okay, we need to hold 109K. It's like a really important resistant level.
Hmm.
And then it was when it just wicked, just bang, all the way down. And I mean, if I look at it was different across a lot of different venues, but let me just this was kind of the crazy stuff. I mean, this is all in the space of like 15, 30 minutes. This is the
Hmm.
Kraken BTC USD chart. This is this the 4 hourly? Yeah, it's the 4 hourly. It's not quite the daily. This wicked all the way down to near 100K. I remember watching this one and
Hmm.
just like it bounced and then was like hitting 103. And I was like, holy shit, are we are we going further here? Is this gonna like keep going? And I mean, we were fighting and battling around this 105K mark for quite a while. And it was only when we started to like recover back up to 106 where I was like, okay, we've got some kind of semblance of stability kind of going on
Hmm.
here. But it was it was a pretty intense drop for sure.
Yeah. That was a moment. Great buying opportunity.
If you could get your orders filled,
It's
yeah.
yeah, yeah. It's
I mean, it would.
it's amazing to think though, like, that we're afraid of dropping below 109. And I know that that is like the
Yeah,
state that we're in, but in the grand scheme of things, as long as we've been around in this space, like I remember in the early days getting really upset that I bought in after 2K or something like that, you know. Uh
yeah. 2017. I remember when it was like, okay, BTC seems very frothy at 1K, but ETH, well, that's on its way up to $100. I was thinking back to these days, like, yeah, I remember those. That would have been great. Wouldn't have to fuck around with leverage trading if we'd have just actually just bought more then. Uh, but hey, but I think So here's where I think this is kind of crazy. So I mentioned earlier, a lot of this was actually quite I was showing the spot market there, but a lot of this was really isolated to initially the perps market. We saw 19. Well, actually, like this number is probably very understated. Um, there's $19 billion in notional value liquidated on Friday. That is by orders of magnitude the largest day of liquidations in crypto ever. Here's some
mhm.
context. When COVID crash hit, it was 1.2 billion. FTX 1.6 billion,
No
right?
way. Wow.
Yeah, right. This is the scale. And this is also a function of the fact that there's so much more open interest. Like people were mega long, right, at this point and levered up. And there was a bit of a perfect storm that happened here. And so I talked about BTC then. The way crazier stuff was happening on altcoins. So a whole host of altcoins briefly hit almost near zero. I'm not talking about tail meme coins, right? Like we're talking about the likes of XRP, like drawing down 80% in like a few minutes. Uh,
Mhm.
I think, what was it that Atom, which I can't remember the exact price of Atom, but let's just have a little look. If I just take a look at this, right? So Atom, which is I don't know the exact market cap, but it FTV will be over $1 billion almost certainly. Um, this was sitting at around about $4.30, and I think on Binance, I think I'm correct in saying it was on Binance. It hit almost zero, like a couple of
Mm.
cent on the perps market. It's like that kind of drawdown has never happened in this
Hmm.
kind of level. So it was across so many assets. Loads of them have, recovered. They're still down
Yeah.
from where they were. But I think what's important is like understanding the events leading up to this kind of crash to understand why this got hit so much. I mean, the S&P and the Nasdaq were down on Friday, something like 2.5, 2%, right, which is quite a lot, right? It's a big drawdown for Nasdaq and Co. But like, that wasn't even as big as the April drawdown that we had. Um, so I think here's what's important to understand for everyone. There has been an absolute frenzy around perps. For those of you that aren't familiar with perps, perpetual futures contracts, these I'll explain a little bit about what actually perps are shortly, but allows you to trade with very high leverage across all different forms of assets. But the thing that's really launched this frenzy has been the rise of the perps decks. So Hyperliquid being one that, me and you, Austin, we've talked a lot about, hugely
Yeah.
successful. I think now does somewhere in the region of a quarter of Binance's open interest. And, no one's even come close to challenging those kind of numbers before. There's a huge amount happening there. And obviously with the success of Hyperliquid and the Hype token, and all of the price appreciation, we've seen a flurry of these perp dexes launch because they want a slice of the pie. Derivatives like perps are very lucrative. Outside of margin trading, perps are the most lucrative. Perps trading is the most lucrative like instrument in crypto by far. Right, you make very small amounts on spot traders actually, and where all of the margin is made is on primarily margin traders and then perps traders. So you have the likes of Asta, Lighter, a bunch of these other perp dexes that have been launching, and some of them are like pre-token, some of them are pre-airdrop, and they've been doing points programs, and a lot of this has been focused on juicing up trading volume, right? So you get points for more volume that you trade, more leverage that you take on. I think some even rewarding liquidations. Like, so, people have been upping their risk to the max, and crypto perp volume is like an all-time high. In the run up to this, everyone was overwhelmingly long, right? Everyone was mega
Hmm.
bullish. We just 2 weeks ago hit BTC all time high, right? And there was
Yeah.
that pullback. It's hard to be sure. I was very bullish about where we were going to be going. Now, there was also lots of positions that were being taken with a lot of leverage on some of these altcoins and longer tail altcoins, memes, etc., that do have less liquidity. And then I think we talked about this a couple of months ago where that old BTC wallet kind of just woke up that had $11 billion worth of BTC in it.
Hmm.
Well, they went and set up, this was last week, a $600 million 8x leveraged short position on BTC, and also a 300 million leveraged short position on ETH. Pretty big short
Yeah.
position. They put, I think, like they topped up their short position, and 30 minutes later, Trump drops the bombshell that he's threatening a 100% tariff on China. And this is the catalyst, right? Markets completely freak out. Trade war 2.0. I mean, we remember what happened in April when the first kind of big worries of the trade war happened. Massive sell off. Um, and this is kind of then where we begin, right? Big sell off happens. We start seeing that. It's also the fact that it's announced, like Trump's Truth Social post was announced, I think 1 hour before the market close of the equity markets. So going into the weekend, far less liquidity, right? Typical banking rails to like get more funds into exchanges are not operating in the same ways they would if this happened on a Tuesday or a Monday. So low liquidity, markets just closed, huge tank, and you've got all this leverage in the system and this one massive short position on BTC, not
Yeah,
the
I
only
mean,
one.
that short position is incredible. Uh, it's insane to think that it was top just 30 minutes before the Trump announcement. I wonder if it belongs to Baron Trump or something like that. Like, what is
Many,
the deal with this?
many questions are to be had around this. Uh,
What's amazing to think about a wallet like that as well is, not to go off track here, but I was just thinking like you either have to be very ideologically committed and like live a very simple life and not really care about material things, or you have to be already independently wealthy to have a wallet of that size dormant for that period of time. Like if that wallet belonged to me, I would have probably pulled $1 billion out of it at some point to like finance a change in my life. So it makes me think, well, the only reason I wouldn't is if I was independently like wealthy prior to that, or if
mm,
I was like basically I don't really give a shit about anything material. I'm like a terminally online person, you know?
yeah, you gotta. My take is probably if you have $11 billion worth of BTC in a really old wallet, it's probably not your only wallet.
You probably have others. Yeah,
Yeah.
exactly.
But it is a good point. Like, why? Like, why did it just wake up like a couple of months ago? Like, when that position first got put up, my other thing that I was thinking about is like, man, like this is a non-consensus trade. Like, what are you doing? Yeah, like, what's going on?
Mhm.
Like, why risk so much? Right? Like, that gets wiped out. You're in pain, I guess. But someone must have known something. I'm not going to speculate on the conspiracy here, but the timing is just unbelievably coincidental. But that to one side, that that's it. So that short position was set up on Hyperliquid. Now that short position alone obviously isn't going to like just tank a market, but it's important to know as things are going down that obviously that um, there's a huge amount of profit being racked up on that short trade. So let's talk about the events that followed the the initial sell-off. So as we've often seen, and when you have a lot of open interest, i.e., there's a lot of leverage positions set up. When this happens, you trigger a huge cascade of liquidations, right? So if people are
Mhm.
overwhelmingly long, they have liquidation prices where when BTC, for example, hits that mark price, the exchange automatically sells off their position and closes out the position. Obviously, puts downward pressure further on price. And then the cascade, the spiral kind of continues, assuming you haven't got more people coming in long to bid that price back up. Okay. So what we start to see is like a huge knock-on effect into the spot market too, which is usually the other way around, actually. Like perps track to the spot market. So it's kind of it was strange to see the movement happen so much. But with this, the price fell so rapidly that, I mean, pretty much all, whether it's a perp dex or a centralized exchange, they're just not able to liquidate in time. So what you have is like some of the long traders position, they fall into negative equity. So in this situation, right, let's say like you take out say you have $1,000. You use that as collateral to create a 5x leverage long position. That means, you have 1,000, you now have a position that's worth $5,000 because 5x leverage, right? You borrow, well, you're not borrowing, but like you're taking out leverage on a perps position. So your total position value is $5,000. If your maintenance margin, i.e., the percentage of your collateral like that decreases, reaches a certain limit, you get liquidated. Some people know this like the liquidation price, right? So most of the time varies greatly, but if your losses mean that your initial like collateral that you put in, that $1,000 of equity, drop down to $400, you get liquidated. They close off the price. So in this situation, right? And I think the thing that people often don't realize is like, okay, so if my $5,000 position of notional value, which I've collateralized $1,000, all that has to do is go down $600, right? The position, the $5,000 doesn't go down 60%. It's just your collateral. So if it just loses $600 of value, i.e., it goes down to 4,200, you are down to $400, right? So 12% decrease in your actual like notional position means a 60% loss to you, right? So, and then you're liquidated. So, and obviously to the upside is the same, right? So it's great. You can get big upsides, but this is just on a 5x leverage position. Now, the reason why auto liquidations happen and they keep like that 40% and not when it just goes down to zero is in case, so there's some buffer, right? Where they're able to close the position and also account for things like slippage. So a liquidation happens by basically like, the exchange forces the position to close, but someone still needs to be on the other end of that trade, right? It's still a trade that goes in to sell off, right? And close the position. If the price just tanks so quickly, let's say you're trying to sell that BTC, maybe your liquidation price is 111K. The liquidation tries to happen at 111K, but if it wicks down so far and it doesn't get filled till like 107K, now all of a sudden you have not liquidated at that price, which gets you to there, but actually you could be in negative equity. Your balance could kind of move to like minus 100. Right. And we saw this happen quite a lot, like a load of stop losses, myself included, just got blown through and didn't fill because they were like, there's not enough longs like coming in here there's not enough like trades on the other side to take that price. So this happens way more on these lower liquidity markets like the altcoins as well. So what happens when it falls into negative equity? Well, there's a couple of things that can happen. Sometimes exchanges have like an insurance fund, right? So whenever you get liquidated, let's say it liquidates in my example before when your equity reaches 400. Technically, right, you'd be like, okay, cool, I got liquidated, it closed my position, I have $400 like left. Well, no, because the exchange charges a liquidation fee, there's some buffer, there's always some slippage, you nearly always go to zero. And then that liquidation fee often goes into like an insurance fund so that if traders go into negative equity, the exchange can like balance it out by taking from the insurance fund and paying, like rebalancing things back up. Now, a lot of these exchanges don't even have insurance funds, and some of them don't even trigger them initially. What was happening is that actually the majority of the time, and nearly almost every exchange that was doing perps in any kind of size, all of the DEXs did this. They triggered something called ADL, auto deleveraging. So important, like final piece without getting too deep on perps. Perps are like a zero-sum game here, right? It's a zero-sum trade. If I want to, go like long one BTC, there has to be people, like someone or a group of people that collectively are going short one BTC. When you close your
Mhm.
position, you pay out the shorts. When the shorts like close their position, they pay out the longs. Either like someone loses, someone wins in equal amounts, and it has to balance. And so if one side is not getting liquidated the right amount, there's a deficit to pay to the other side. So what ADL does is it says, okay, in this case, all of these short positions are getting massively into profit, right? Because price is tanking so fast. All the longs are getting liquidated, but we haven't been able to recoup enough to pay these short positions that are so in profit. And there's not enough of them that are closing their position and taking profit. They're just riding this because they're like, yeah, I can get more and more and more. So ADL triggers in and it goes, okay, it freezes the market. No more bids goes in. And what a lot of people find kind of controversial, and I think a lot of it is just because a lot of people didn't realize ADL is actually a thing, is that they say, okay, X amount of traders on the long side are now in deficit. Let's just make up a random number, right? There's like, $1 million worth of negative equity that we need to account for because we can't pay out these traders. So ADL kicks in. They say, okay, let's take the traders on the short side that are in profit, that are in, and the criteria varies by exchange, but most of the time, that are most in profit and with the highest amount of leverage. So the ones that are going to, like, if this keeps going down, make way more, and we're going to close that position. Right? Without there's nothing that they say. We cap their winnings. We close it. They settle their position, and it means then they're taking basically a haircut. So as the price then goes down further, this group of people basically have paid for the deficit, and then balance starts to restore. The market opens back up, and everything is balanced. The people that were in negative equity are no longer in negative equity. They're just at zero. And the people that would have stood to gain even more still made money, but not quite as much, right? So it's like, oh shit. But what happens is the chaos during all of this. So when the markets close on less liquid markets, first of all, there's no more bids that can happen. So if there's really low liquidity, even like market makers can't bid. So that's how prices on the alts could just like keep going down, right? But there was also this other crazy part. This is the last thing I'll dig into because I know we're getting like a little bit dense. But one of the things that really drove everything down so much is the amount of basis trades or delta neutral trades that got wrecked on perps. So this is largely a function of all of this incentivized volume. So a delta neutral trade is where you are either both long and short the same asset, or you're long and short kind of like negative beta assets. So like, let's say you go 10x long, let's say you're $1 million long ETH on Hyperliquid, and then on Lighter, you're $1 million short on ETH. Now it's like, well, why the hell would I do that? I'm just like canceling out my trade, right? It's delta neutral. Well, the reason being, like, you on one side of that trade, you pay a funding rate every like hour or 4 hours. And on the other side, that funding rate gets paid like either longs pay shorts or shorts pay longs. So there can be like some arbitrage where you're basically earning a funding rate. It's like earning a yield basically by doing this. A lot of people were doing these basis trades where they're like, okay, cool, I'm just earning this yield. If the price goes up, the price goes down, it's fine because I have an equilibrium. I'm equally short and I'm equally long. So that's kind of okay. That all goes to shit when ADL happens, right? Because a load of people were doing these delta neutral trades because they were like, oh, I can farm volt points on this exchange by going short there, and I'll farm points on this one by going long there, do my delta neutral thing. If exchange one triggers ADL on your short position, cuts you, now that position's closed, you are no longer delta neutral. And your long position goes and just gets liquidated, but your short position is not gaining profit anymore. And all of a sudden, you've just got absolutely wrecked. And most of the time, all you can do is watch. And it's just, and that happened in huge amounts. So we just saw this carnage basically of just like this cascade that was happening across all different types of assets. Um, and then, rippled into spot and eventually kind of washed out leverage to a certain level where then it was like, okay, bids are coming back in, all of the ADL has stopped, normal order is resumed, and we can start bidding back up again. And that was equally crazy to just watch, like after it all go down, then come back up. So yeah, there's a deep dive into derivatives chaos, which I know is a lot.
It's amazing.
But yeah, that's the TLDR of what happened. I think it's going to be
Yeah, I mean,
really.
what's really interesting, there's a few things about this that are interesting to me. One of which is just these direct ties between the crypto market and had political headlines.
Yeah.
This wasn't really just like a crypto native leverage explosion. It was a macro feedback loop in real time. You had a political headline about tariffs hit a market built on a ton of algorithmic leverage and reflexive liquidity. And I think that this, could be in some ways a preview of how geopolitics in the future can kind of trade through DeFi. Like we always think
Yeah.
about, crypto as being this isolated thing. But it's actually very macro sensitive. And that lag between the policy threat, which was effectively just Trump's China tariff threat, and this $19 billion liquidation cascade was like a matter of minutes.
Yeah.
So it's really incredible to me to see just the general like sentiment sensitivity outside of crypto, that crypto has to that. And then
I
at the
think
same
also.
time,
No, you go ahead. You go ahead.
yeah. Well, at the same time, I guess we were talking about like this convergence collision path, however you want to put it, that AI and crypto are on at the moment. And I think that this was maybe like our first on-chain flash crash of the AI trading era. We now have like these AI driven perp strategies that are running at a pretty good scale. And when that sell-off started, these automated strategies really amplified it big time. They didn't
Yeah.
like dampen it or slow it down. This volatility that we're talking about, it largely wasn't human. It was like algorithmic reaction or reflex. And so this is kind of an interesting market dynamic, right? It's not so much about emotional sellers; it's about systemic ones. Like I have my sort of sell off threshold, and when Bitcoin goes down to 109,000, I sell, and then my neighbor has it at 108,000, but because I sold, it went down to 108,000, so he
Right.
sells too. And neither of us did any of this actually. This was like,
Yeah.
purely an automated and algorithmic reaction.
And that's where I think with like and why things get so wild with perps, right? Is it's forced selling most of the time as well, right? Because like you're getting liquidated. Like there's nothing you can
Hmm.
do. Also, I think the other thing with like the decks is like, if if you're very long on a leverage trade, on a perp trade, and you're getting close to liquidation price, I mean, one thing you can just do is just top up your collateral, like transfer more USDC or whatever into your Munch account. Gas fees on ETH spiked to near $1,000. Remember the NFT era? Yeah. So
Yeah.
like people trying to even just like fund in these decentralized perp decks, obviously gas fees went wild and they just weren't functioning, right? Like there was so
Hmm.
much of an overload. So there's nothing even really people could do. Like I've been playing around in a bunch of like perp dexes and do just little bits like of leverage trading, more for just like a little bit of fun, small amounts. And I was just watching and I was like, do I even try? Like I was just watching my liquidation price and I was like, that like action is futile here. This is
Hmm.
this is just watch yourself in 4K get liquidated. Nothing you can do is going to stop this. Just embrace
Open
it.
another beer.
Yeah, exactly. I wish I'd have like just screen recorded at the time, just to be able to share the moment. But it's just like there wasn't anything we could do. And I want to touch on one of your points that you were making as well. It's like I think also here during like what happened after like the Trump announcement. Well, gold rallied, equity markets tanked, and Bitcoin and crypto tanked. And as much as there's always these glimmers of like, is this a hedge against macro chaos? We are so much more connected to equities than we are to even inflation hedges, which we've talked about before, like gold. I mean, gold is on a meteoric rally. Silver is like, just gone through a crazy short squeeze and now it's up, well, like 85% year over year. I saw there was like, because there's a huge supply shortage of silver in London, which is where like a huge part of precious metal trading doing. People in the US have been like shipping over like silver bullion to the UK to take advantage of the ARB. Like it's amazing. Like,
Yeah.
but yeah, I mean, it is. We're still so linked to this. What I will say on a more positive note, right, is like huge amount of leverage has been flushed out. Okay,
Mhm.
let me reframe that. Maybe that's not necessarily a positive thing for everyone, myself included, that got liquidated in the process. But what it does mean is like, the risk has reduced. If we just kind of look like here, right, like this is like that
Mhm.
aggregated just BTC open interest. Open interest, for anyone that doesn't know, right, is like it is the amount of leverage, notional trading value that is currently open in positions on a perp contract. So like, if one if there's a BTC long for one BTC and a BTC short for one BTC, that's one BTC of open interest, right? So you can kind of see here, like, we were at like $44 billion. This is just Bitcoin as well. And then in the space of fucking no time at all, all the way
Mhm.
down to what's the depth here, like 31 billion in notional value.
Mhm.
And you kind of start to see, this like recovery. This was on the 12th, which is Sunday. I think we had that like slight rally. People started getting long again, and then it's been like, sideways. We're at like, around about similar levels to the first wave of sell-off. So what I would say with that is, what I would interpret from it is like the downside risk is much less. I think it all depends still on geopolitics, etc. We've got less potential good macro news because I think an October rate cut's priced in already now. We've got inflation data coming now at the end of the month. Maybe that could be good news. But at least like the flushing out means like the swings either way are not going to be too crazy. But I'd imagine we
Yeah.
get a bit of a consolidation period before any moves upwards.
Mhm. Well, it's been it's been a really interesting thing to watch from the sidelines, I will say. As somebody that is, you know, not one to engage in these leveraged positions and longs and shorts and perps and everything like that. It was definitely wild to watch. So,
Yeah.
uh I'm sure that this is not the last of this that we're going to experience. I mean, it really is amazing to me to think about just the scale of impact that the FTX crash had, and the fact that this is like 10 times, honestly, more than 10 times that size.
Yeah, like nearly
It's incredible.
20x. And honestly, I think like if we actually like account for how much is hard to read via a lot of the APIs and stuff like that, it would not surprise me if it was at least double this. But like,
Hmm.
I think the reality is, if we unfortunately take ourselves back to the period of FTX, it was pretty bearish in the run up to that. There wasn't like huge
Mhm.
amounts of longs, like an open interest set up, right? Like, so, there's less to get wrecked on.
Yeah.
FTX certainly felt way more painful than this did, but this was just a
Yeah.
wilder swing for sure. Um,
Yeah.
but yeah, we'll see how this plays out. I think we've talked this piece to death. We'll chat a lot more about this, but I know there's also like there's been another kind of big race hotting up around probably like the second hot theme in crypto, right? You got like perps
Yeah, that's
trading this
right.
year, and then stable coins. Why don't we dig a bit into this?
Yeah, so I wanted to talk about this real quickly here. I think that Wall Street is really waging just a quiet race to build its own stablecoin at the moment. And you're right, Matt. I mean, stablecoins are hot right now. A lot is happening in that space, largely because of the regulatory shifts that we've been seeing. But this is something we've been talking about for some time. You'll recall a few months back, we talked about Citibank experimenting with tokenized deposits. And then we also talked about JP Morgan's Onyx network quietly moving billions of dollars onto its own private blockchain. And at the time, I think we were saying, this is a pretty good sign that Wall Street isn't fighting crypto anymore. Rather, they're trying to absorb it. And
What's
take that how
better?
you will. Yeah, I know exactly. Yeah, which
Don't worry, guys. They're not trying to fight us. They're just trying
double-edged
to absorb
sword and
us.
do you want? Yeah, and I really want to get into the implications of that. Like, that's the main reason why I wanted to talk about this. But the main theme here is that this trend that we were seeing of Wall Street not fighting crypto, but rather trying to absorb it, that trend is continuing. So, Bank of America, Citi, and Goldman Sachs are reportedly exploring a joint stablecoin, which is a shared digital currency that's pegged to G7 fiat. So, basically, they're going to be taking the G7 countries' fiat currencies and pegging their stablecoin to a basket of those.
Remember
Meanwhile, at the
Libra?
same time, yeah, I know it does sound familiar.
Does,
Yeah,
doesn't
good
it?
callback. Yeah. And then at the same time, US Bancorp just launched a digital assets and money movement division, which is signaling a deeper shift. It's not side projects anymore. It's part of their core strategy. And the goal that I'm seeing here is, faster interbank settlement, better cross-border efficiency, and also a hedge against future CBDCs, basically central bank digital currencies. So Wall Street wants to own the rails of crypto style payments, not just plug into them, I think is what's happening here. And the question then becomes, okay, well, why now? And why does this matter? Well, I think that there are a few factors at play here. The first of which I already mentioned, which is this regulatory shift that's happening. The OCC and Fed, they aren't slamming on the brakes. This kind of coordination that we're seeing between these big banks, it wouldn't happen otherwise if they didn't know that was the case. And then there's also this theme of control over the rails. So if banks issue stable coins, they're kind of bidding to replace Circle and Tether as the default intermediaries of digital dollars, which, today have kind of become like these giant, almost immovable incumbents. And then there's the factor of systemic impact, which, you have a consortium backed stablecoin that could settle trillions daily, which, I mean, could that rival Swift and Fedwire and like all of
It's
this
been the
incredible
been the promise.
infrastructure?
It's been the promise
Yeah.
for a long time, right? And
Yep.
I'm sure that's the value or the TAM there is obviously absolutely enormous that
Mhm.
everyone seems to be going after right now for sure.
Yeah. And then you have this incredible market signal finally, which is that, the big banks, they're no longer playing as spectators, right? They're not just investing, they're quietly rebuilding some of the plumbing of finance with blockchain under the hood. So this sounds, I don't know, how does this sound? Does this sound good? Does this sound terrifying? I guess I have a few thoughts on this. The first is that this isn't really banks adopting crypto, which is what we've seen a lot of in the past. Rather, it feels like banks annexing crypto. And I know that that sounds scary, but they're kind of doing what they've always done, which is taking a decentralized innovation and rebuilding it under centralized control. They're effectively co-opting innovation once the risk is gone. And maybe that's inevitable if we're being totally honest. You know, every
Mm.
open technology eventually gets domesticated once institutions realize, hey, this isn't super risky and it actually kind of makes sense and it works. And I think that though that might sound dystopian, it is, if we're being honest, it's bullish for adoption and efficiency. The irony is that by trying to replace USDC and Tether, banks will end up normalizing on-chain settlement, which is sort of the thing that crypto wanted all along. However, I think we should be honest about what's being gained, which is everything that I just talked about, and what's being lost here. Because so far, I would say, my sentiment toward banks and traditional institutions getting involved in crypto has been like cautiously optimistic.
Yeah.
This is getting I'm definitely erring further and further to the side of cautious with this news. I think that faster settlement is good. Adoption and efficiency is good, but in this case, it does come at a cost of openness, a cost of interoperability, a cost of permissionless access, and that's a different kind of trade than the ETFs were. This is a lot more serious to me.
Yeah.
Stable coins were designed as a workaround for this old antiquated system. And if they just become a new product within that system, as opposed to a new system in and of itself, that innovation shifts from disruption towards something new toward optimization of the old, which is still a win, but it's really like 10% of what we actually wanted to achieve with this technology. And I will say, like, as a matter of principle, and a matter of principle and maybe just a matter of practicality, I'm not against progress through institutions. Like, I do think that progress can be made through these traditional institutions, even though I think many of them are fundamentally antagonistic to capitalism and economic freedom and so on and so forth. I don't think that we should mistake institutional adoption for ideological alignment. And banks, like, they can totally adopt this technology without actually like really believing in the fundamental tenets of it, because they aren't, like, just by nature of what a bank is, it's not here to decentralize. Banks are here to stay relevant and to maintain centralized control. That's how they win. So yeah, this might be something that's bullish for stability of the ecosystem, for like building really good infrastructure, for faster settlement. But if crypto's biggest success story in stablecoins ends up being a smoother version of the same gatekeeping that we've always had, I don't think that that's the future that we were aiming for. And
Yeah.
that's really what, that's that future that I was just describing. That's what disruption looks like when it succeeds halfway, or maybe a quarter of the way, or a tenth of the way, which is basically that. And the tech survives, but the intent behind the tech gets diluted away. And this is something that, like, I have seen this throughout my career happen over and over and over again. The open web is perhaps like the closest to my heart as a casualty of this, to like large internet giants that generate incredible amounts of capital and then build walled gardens and all of this stuff. It's like that fundamental tech that's powering all of that has survived, but what was the intent behind it? If you're old enough to remember what the old internet was like, then it kind of irks you a little bit. So, I don't think that this is like hopeless.
No, I do think so. I think it's super important that we're like very skeptical around stuff like this, but I feel much more optimistic here because I think what's happening right now. So first of all, the things like the Genius Act and like the regulatory frameworks that now exist for stablecoins mean that traditional financial institutions, banks, etc., are are really able to get involved within their own risk tolerance. I think also the deregulation that's came since the Trump administration has helped them jump in.
Yep.
And I mean, the reality is the reason why there's so much momentum around this is one, uh, from financial institutions. One, the huge profit to be made from stablecoins, and two, which is intrinsically linked to this, is that their business models are materially at risk. I think really for the first time here, and you look at Tether as a great example of this, and they're one of the, I think them and hilariously Hyperliquid, I think are like the highest profit per employee in the world, like one of the most profitable companies in the world,
Mm-hmm.
and of all time. Um, and, raising around currently at the same valuation as OpenAI and actually having some of the revenue numbers to kind of back it up.
To back it up. Yeah.
But what I think is important here, right, is like if you think about like traditional banking, and I think Europe is a good example where we saw the rise of the neobank over the past 10 years. And neobanks became really, really influential and are now extremely influential. Neobanking being, a bank that has no physical stores. It's kind of unthinkable 20 years ago. It's like you can have a bank with no branches. How are people going to go in? How are they going to access their cash? What, they can't just like go in and do this, speak to someone. But what they did is they said, hey, like we are going to build our business model around what this generation values, and give them back more, right? And it's like kind of taking the more credit card model, rewards, giving out more incentives. The interest rate that you were getting, which was largely paid out of, largely marketing costs here, or passing back more interest to the clients. Whereas, in your traditional banking, the Fed funds rate could be, 4.5%, and you're still getting like 20 bips of interest in your account. It's like, what? So now with stable coins, it's a whole new level where it's like for neobanks in particular, and this is why we're seeing an explosion in crypto native neobanks rise, because the margins to be made on stablecoin yield, where you're ultimately holding all of the deposits, making a huge amount from short-term, long-term treasuries and other vehicles, you're able to pass that, so much more of that back on to clients, reduce all of the antiquated fees. Settlement is so much easier. Cross-border is basically non-existent in that respect, right? It's a single system. This all becomes so much easier to do. The question for me is, for the end user, it's going to make absolutely complete sense for why they would not want to go with the traditional banking model. The real question is, are we going to actually, over the long term, pass these profits back to users, or are we just going to fatten the margins of the banks and the issuers of stablecoins and give the same amount back, the same experience, but just absorb all of that margin into profit? And what I hope is the former happens and not the latter. But I think there's a happy medium there, and I think banks see it because it's so much easier now for sustainably these for any of the new like crypto players, neobanks, to go and provide very attractive saving rates globally to users.
Yeah, I mean, I feel a lot better about the neobanks, or at least the ones that, the neobanks that aren't just are rebranded and backed by like the huge traditional banks, than I do about, Bank of America, Citi, Goldman Sachs, JP Morgan, and all of these like huge traditional institutions, getting involved in a space that like really requires some like ideological honesty, and then also technological innovation and accountability, which they're, historically they haven't been very good at either of those. But I, as I said, I don't think that this is hopeless. You mentioned the Genius Act. I think that that's huge. I think that the challenge here is for builders and regulators to just hold the line on openness. It may be as simple as that, to make sure that the infrastructure stays interoperable and not proprietary, and to understand that progress doesn't have to mean surrender of an idea. I think that this is the moment to double down on open protocols, public infrastructure, and, as I said, interoperability. If crypto is going to underpin finance, including traditional finance, it should do so in a way that anyone can build on, not just the big banks. And regulation can play a huge role in that. I think regulation shouldn't be designed to protect incumbents, as it far too often is. It should be about keeping the rails fair. If stablecoins are going to be regulated, we need to make sure that that doesn't mean only the biggest banks get to issue them. The Genius Act, as you mentioned, Matt, that lays a pretty good basic foundation for this by creating a federal framework for payment stablecoins, which requires one-to-one backing, auditing, limits on reserve use, and dual federal and state supervision. So I think that that's pretty good, but it also allows issuance by depository institutions and approved non-banks. So big banks can still stay in this place. It doesn't explicitly prevent consolidation or gatekeeping via some exclusive access to infrastructure. So I view this as like the first major US law targeting stablecoins directly, but I consider it more of a baseline that we can hold up as a floor rather than a ceiling. I think that there's still more to be done here. And to kind of wrap all of this up, we shouldn't reject institutional involvement in crypto outright. It can be very good, as I mentioned earlier, but we also shouldn't confuse it with the future that crypto was built for. The work now that I think is in front of people in this space and in front of regulators is making sure that the values of decentralization survive their newfound contact with real power, like these giant banks.
I agree. I think that's very well said. And this stablecoin space is only going to keep getting hotter and hotter. So yeah, we'll keep an eye on that. I know we're pretty much at the hour now, so we'll wrap things up, but we'll keep tabs. There's going to be loads more happening. There's also a lot happening in Europe on stablecoins as well, while we have a huge gap in stablecoins, with majority of all stablecoin liquidity being USD denominated. And then, yeah, let's see how the next couple of weeks play out on the crypto market side. Hopefully we see a nice resurgence at some point, but all really depends on the geopolitics. We'll see.
Yeah.
I doubt it's going to be a dull week next week. That's all I'll say.
Yeah.
All right, man. Well, I'll see you next week and we'll go through it all.
Yep. Talk to you then, Matt.